Order block is not smart money concept. There are 7 institutional reference points you need to learn. Watch this video.
Hi forex traders, you're welcome back. If you are a returning viewer on this channel, you're welcome back, and if you're a new viewer, kindly click the subscription button and don't forget hit the notification bell so you stay updated every time I post a video. So today I want to show you why I said order block is not smart money concept. Recently I met a lot of traders who think all that there is to smart money concept is just break of structure and return to order block, and I'm like, what in the world, or where in the world did they learn how to trade smart money concept? Because if you truly learn smart money concept the right way, you would know that order block is not all that there is to smart money concept. Okay, so quickly, what are even order blocks? Order blocks are an institutional reference point, and if you are talking about institutional reference point, there are actually about 7 institutional reference points that were taught by the engineer of the smart money concept himself. Okay, there are 7 institutional reference points that you will need to learn if you truly want to use smart money concept appropriately the right way and stop getting burnt all the time. Most traders get burnt and they keep asking questions like, oh, I waited for breaking market structure, price returned to order block, but I was swept out of the trade. And it's literally because the only thing you are seeing is order block. Then there are another traders who are saying price never returns to order block. Yes, price doesn't have to return to order block because there are other more powerful institutional reference points more than even order block. So sometimes the institutions do not have to come back to another block to position their trades. They don't have to come back to an order block. Okay, if you pay attention in this video, I'm going to show you the 7 institutional reference points that exist, and in my subsequent videos I'm going to show you how to apply all these 7 institutional reference points appropriately in your trade analysis and during your trade. Okay, so like I said, there are 7 institutional reference points, and these are those 7 institutional reference points. The first is mitigation block, the second is a breaker block, the third is a liquidity void, the fourth is a fair value gap, the fifth is another block, the sixth is a rejection block, and the last is an old high or old low in their order of importance. This is how you are supposed to be looking at price, or you are looking at the charts every time you are looking for where the institutions are going to position their trades. You are supposed to be looking at a mitigation block first, and in the absence of a mitigation block, you should identify a breaker block. In the absence of a breaker block, you should be able to identify a liquidity void. In the absence of a liquidity void, you should be able to identify a fair value gap. In the absence of a fair value gap, you should be able to identify another block, either a bullish or a bearish order block, and then you should be able to identify a rejection block or an old high or old low. So you can see that in their order of importance, order block is actually the 5th institutional reference point. Not even the second, not even the third, not even the fourth. It's actually the 5th institutional reference point in their order of importance. I know some of you are saying, wow, I never learned about this, but don't worry, I'm going to teach you in this video. So let's quickly look at what a mitigation block is. There are actually 2 types of mitigation blocks. You either have a bullish mitigation or a bearish mitigation block. Okay, now a mitigation is what is popularly called a failure swing by most traders. Okay, a failure swing. Let me put on this, stay in drawing mode. If you don't know how to use TradingView, go to the channel and look for one of the videos I taught on how to use TradingView. Learn how to use TradingView so that you can enjoy your analysis all the times. So guys, I was talking about mitigation block. I said there are 2 types of mitigation block, either a bullish or bearish mitigation block. So let me start by drawing the bearish mitigation block. A bearish mitigation block is when you have a failure swing that breaks structure to the downside. Okay, so assuming that this was a previous bullish move, and then you see price failing to take out this high, and then price breaks structure. This is a shift in market structure, and this is actually a mitigation block. So where is the mitigation block? The mitigation block is the last order block that was violated on the left side of the chart. Okay, so that means the last bullish order block around this region Remember, this was bullish price delivery, and as price was coming down, there is a bullish order block here that was violated. That bullish order block, if you outline it to the left, is supposed to serve as your mitigation block. Okay, so that's your mitigation block. Then you anticipate price to retrace into the mitigation block and then go down. This is a mitigation block, guys. Okay, this is a mitigation block. So let me quickly let me as well also draw a typical example of what a bullish mitigation block looks like, but this is a bearish mitigation block. Let me make it look perfect. So this is a bearish mitigation block. Take note, the difference is that in a bearish mitigation block, price fails to take out the swing high, the last higher high, price fails to take it out, and then price formed a lower high, okay, a lower high, and then price breaks structure to the downside. So once you have a failure swing and a break of market structure, the last order block here, bullish order block that was violated, is going to serve as your bearish mitigation block. And the reason why the institutions will do this is because of buyers' remorse. There were a lot of buyers in this market and they were taken by surprise, and then price broke structure. They didn't expect that price was going to start selling, and then price sold. So the institutions will actually mitigate those buyers, those buy orders, because the buyers have shown remorse. It is actually called buyers remorse. So they are going to mitigate their buy orders so that they can reposition their sells here and take the new sell position. Then a bullish mitigation is when you have price has formed lower low, fails to form another lower low, and then instead price breaks structure to the upside. So this is a mitigation block. We need to see price retrace into that our bullish mitigation. And what is that mitigation block? It is the exact bearish order block here that was violated. Instead of price to react at that bearish order block here, price violated the bearish order block. When price returns, this is actually a bullish mitigation block. What are the criteria for identifying a bullish mitigation block? First, you need to see a failure swing and then shift of market structure. So this is simply what a bearish and a bullish mitigation block looks like. Then let's quickly identify the second. In the order of importance, remember the second one is a breaker block. Now there are two types of breaker blocks, a bullish and a bearish breaker, and the difference in this case is that unlike in a mitigation block, we said we need to identify failure swing. In a breaker block, we need to identify what is called a turtle soup or liquidity hunt or stop hunt or liquidity grab, anyone you want to call it. A stop hunt first, and then price break structure to the downside. You see this? Price takes our liquidity above price breaks structure. Okay, price takes our liquidity here, and then price breaks structure. So that bullish order block here that was violated is going to serve as your bearish breaker. By the time price comes back to it, we really love to see a reaction at that bearish breaker block. So this is a bearish breaker. Let me quickly draw a bullish breaker. A bullish breaker likewise would be when you have a lower low and price forms another lower low, and then price breaks structure to the upside. The other block here, which is the bearish order block that was violated, will serve as your bullish breaker block. Okay, so that's the bullish breaker block. Once price returns into this is our bullish breaker block. So what are the criteria? We need to see a lower low form or liquidity grab, or price takes our liquidity, or stop hunt below this. Now one of the indexes that tells you this is going to form is when you see quick rejections immediately after price takes out that low. You see that the candle of the body will close below here, or you would see the wicks are really are forming very fast. You see a strong candle rejection or rejection candles, and then price break structure in the opposite direction. So this is a breaker block. Okay, now remember I said in their order of importance. That means if I'm looking at price, I want to see a mitigation block first before I see a breaker block. If the mitigation block is not there, okay, I'll be looking for a breaker block first, And then the next is a liquidity void. A liquidity void simply means a one-sided price delivery. For example, if the institutions have been buying and then you see it's been all buy candles without sell candles, this is liquidity void. Or you see all sell candles without buy candles, it is called liquidity void. Okay, I'm going to show you all of that on the chart literally. And then the next is another block. Okay, the next is a fair value gap before another block. Now a fair value gap is a 3 candle price action where the high of the first candle and the low of the third candle do not match, or the low of the first candle and the high of the third candle do not match. So for example, what this means is that if we are bullish, okay, in a bullish price action or in an efficient price delivery, we need to see the open of a new candle being matched with the low of the previous candle. This is, remember, this is a bullish price action we are talking of, right? Price has opened and then price expands, okay, and closes here. Now the next candle that is supposed to form should form at the close of the third, at the close of the previous candle. That's where I need to see the open of the third candle. This is the third candle, and you can see the low of the third candle is matched with the close of the previous candle. This is an efficient price delivery. This is how an efficient price delivery looks like. But in a scenario where you have 3 candles, this is the first candle, you have the second candle here, and you have the third candle here, okay, and you have the third candle here, and then the high of the first candle does not match with the low of the third candle. This gap in between is called a fair value gap. The gap in between is called a fair value gap, okay? That gap in between is called a fair value gap. I'm going to show you on the chart. I'm just using this literal illustration so that you understand what the concept really is all about. And then if you are in a bearish price action and then you have 3 candles and the third candle 1 2 3, right, and then the low of the first candle does not match with the high of the third candle, this gap in between these 3 candles, this is actually the body of the candle, this is the body of the candle, so the gap in between is called fair value gap. I really hope this is well understood. Okay, although fair value gaps have different variations, we have what is called a volume imbalance, we have what is called a vacuum gap, and all of that, all of those are actually types of imbalances. Okay, well, I just want you to learn this basic one, which is the fair value gap. And then the next is another block. There are 2 types of order block, a bullish and a bearish order block. And let me say this, these are not the only blocks that exist, okay, in institutional reference points. There are other blocks like the reclaimed order blocks, okay, and thereabouts. So there are 2 types of order blocks. A bullish order block is the last sell candle that was traded through or engulfed by an engulfing candle, okay, to the opposite direction. That is what a bullish order block is. So there are 2 types of order block, a bullish and a bearish order block. Now a bullish order block is the last sell candle that was traded through in the opposite direction, or the last sell candle that was engulfed by a bullish candle. Okay, so that sell candle, the high to the low of the candle, is actually your bullish order block. Now this is the controversy. Some people now teach that an order block or a bullish order block is the last sell candle that leads to a shift in market structure or a break in market structure. That is what some people teach it in most SMC courses that I've seen. But I'm telling you this, that is not really an order block. An order block simply means the last sell candle that was engulfed in the opposite direction by a bullish engulfing candle. That is what it means. Then a bearish order block is the last buy candle that was traded in the opposite direction by a bearish candle. Now there is how to use order block, and there are criteria for identifying the most valid order block. Okay, let me just say this: the most valid order block is the order block that has a fair value gap attached to it. That is the most valid order block. Okay, and another block is when you have more than 1 candle or multiple candles, okay, in a price action, and you have a mixture of large candles and small candles. The other block is the candle that has the largest body. So we are more interested in the candle with the largest body. That is actually the order block. I'm going to show you that on the charts too. Okay, then the next is what is the sixth one? I think it should be rejection block. Yeah, rejection block. So rejection block likewise is a 3 candle price action where you have the middle candle forming the lowest low and the middle candle forming the highest high. So more like a swing high and a swing low. You have 3 candles that have equal candle bodies. Remember, equal candle bodies. The candle bodies usually would be equal, but the wicks can vary. So let's say this wick can be something like this, but the body of the candles are actually equal. The body of the candles are actually equal. Now when price returns to the body of the candles here, this is a rejection block. Okay, take note of this. I said a rejection block is a 3 candle price action 2 where the middle candle has the lowest wick or the highest wick, okay, forming a swing low or a swing high, but the body of the candles are actually equal. So the body of the candles in this case are equal. When price returns to this is actually a rejection block. Okay, it's the same way when you are looking at it in a bullish price action. You have in a bullish price action where you have this, you have this, and you have this. Then the body of the candles, we said the body of the candles are equal. The body are equal, not the wick. The bodies are equal. So let's say this is the body of the candle. Okay, let's say this is the body of the candle. Sorry, forgive me. Let's just say this is the body of the candle. So that's it. When price returns into this is actually a rejection block. I hope this is really clear. Then the last is simply an old high and old low. Okay, simply identifying an old high where liquidity is residing below or above it in a price action. That is what an old high and an old low is. So when you are looking at price action, you are looking at these 7 things, not just another block. This is the only way you are not going to be missing trades, because you have a list of institutional reference points you are paying attention to. You are paying attention to a mitigation block first. If it's absent, you are paying attention to a breaker block. Then you are paying attention to a liquidity void. You are paying attention to a fair value gap. You are paying attention to another block. You are paying attention to a rejection block, and you are paying attention to an old high or old low to pair up shorts with longs or to pair up longs with shorts. Okay, so that's what that means. Let's quickly go through to the chart so that we'll show you how to identify these things literally on the forex chart and every other asset that you know, because these things are actually applicable to every asset that you know. It's tradable on every asset. Okay, what time frame is this? I think this should be the 1 hour time frame. Let me just go to the daily time frame so it makes it easy to see or identify. So one thing you need to learn how to do is to learn how to identify these things yourself all the time. So remember, we said we are looking at a mitigation block first. Mitigation block first. A mitigation block. So what I have here is I have a failure swing. Okay, I have a failure swing. I have a failure swing here. Then I have a shift in market structure. Okay, remember I said the other block that was violated is the mitigation block. So all of this is your mitigation block. I don't know why this is ceasing, but let me see where the problem is. So that is your mitigation block. Okay, we went outline. You see how we outlined it? All of this is the mitigation block. All of the other block from the high to the low of the candle, that is your mitigation block, and that is where you are looking to start selling. Okay, so that is it. That's one. That's a mitigation block. Remember what we said a mitigation block looks like. We need to see a failure swing and then a break in market structure. Let me draw it again. That's what we said a mitigation block is, and this is what it is, right? Price from the high, lower high, and then break structure, returns to the mitigation block. You are paying attention to the mitigation block. Now notice how the body of the candles exactly respect the mitigation block. You are looking for your confirmatory entries around this mitigation block. Now a high probable mitigation block is when you have a confluence of a mitigation block plus a fair value gap or another block. In this case, we even have another block attached to this mitigation block. That makes it a high probability setup. Okay, then the next is, let's identify a breaker block. Let's identify a breaker block. I can see a breaker block here. Okay, a breaker block, remember we said, is it has to take a high in form of liquidity grab or stop hunt, or what is it called, stop hunt, or whatever it is. We need to see liquidity taken on the buy side, and then liquidity should break structure below. This is a bearish breaker block. So what is the breaker block? The other block, all of it here, that was violated, that bullish order block that was violated. Now notice how price immediately retraced into that breaker block and starts going down. In the future, it was even retested again, not the other block like some people say the last sell-off. That's not it here. Look at what price did here. Now the most valid breaker block is the one also that has a fair value gap attached to it or another block attached to it. In this case, if you pay attention, you will notice that there is a fair value gap around this breaker block. Now I'm not teaching how to use breaker blocks, remember, I'm just showing you that these institutional reference points do exist. In the future, I will teach you how to incorporate them in your trading and how to apply them literally in your trade, and you're going to see how powerful these concepts are. So we have identified a mitigation, a bearish mitigation, and a bearish breaker. Now let's identify a bullish breaker and a bullish mitigation block, right? So I think there is one here. Price takes a liquidity here, price breaks structure here, right? Now notice how price immediately trades into the breaker block again. What's that breaker block? Remember the other block that was violated. So if you outline all of it here, pam, 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 pam. Sorry. So look at how price came back into that breaker. Price broke structure, price returned into the breaker block. I remember I said the most valid breaker is the one that has a fair value gap attached to it. Is there a fair value gap attached to this? Yes, there is. There is a fair value gap around this region. Okay, there is a fair value gap around this region. Sorry, I didn't mark this well. The other block, all of it, the low to the high of that candle is actually the other block. So that's it. So price trades into it, and we see that rejection to the buy side. Price didn't go back to that other block. You are paying attention to look at what happened. This is the power of a breaker and a mitigation block. So this is a bullish breaker. Let's quickly identify a bullish mitigation block. I'm just randomly looking at the charts to see where that is, so I can literally show you. Okay, let me see if I can find something to show you here. So we have something here. Sorry, mitigation block, because we have a failure swing here. Okay, price from the low, couldn't take out the previous low, and then we see price break structure above, right? Price breaks structure above. You know how to identify breaks of market structure, I believe, or shifting market structure. Then we said our breaker block is the last other block that was violated, in this case all of this. Our mitigation block, sorry, not breaker in this case. So this is actually a bullish mitigation block. I've showed you a bullish breaker and I've showed you a bullish mitigation. Look at the precision of this price action, and then look at the fair value gap attached to it. Remember I said the most valid mitigation or breaker block is the one that has a fair value gap or another block attached to it. Then look at how price traded into that fair value gap, and price went all the way up. So that is it. Go to the chart and look for these things. You are going to see them all over the charts, guys. You are going to see them. So the next is a liquidity void. Remember, I said a liquidity void is a one-sided price delivery that will be rebalanced. So in this case, we have a one-sided price delivery. It's been all of selling 1, 2, 3, 4 sells. So this created a void, and the institutions will always go back to refill or rebalance those voids. So that's what happened here. Okay, this is a void, liquidity void. It's been refilled. You can see all of these price action was to refill that void. Okay, so that is it. This is another liquidity void. This is another liquidity void. You see, price went to refill that void. Okay, this is another liquidity void. Price went to refill that void. This is another liquidity void. Price went in to refill this void. Okay, so that's what it is. You will see a lot of voids in a trend, a good trend, either bullish or bearish trend. You see a lot of voids. So this is liquidity void, this is liquidity void, all of these voids. So that is it. The next is a fair value gap, and then we said the fair value gap is a 3-candle price action where the high of the first candle in a bullish trend and the low of the third candle do not match up. So this is what it is. Number one, first candle here, you have the high of the candle and you have the low of the third candle not matching up together, thereby creating a space in between them or a gap in between them. This is called a fair value gap. Okay, when you go through your chart, you will see a lot of it happening. You can see it here, you can see another one here, you will see it happening all over the place. Let me show you another one here. Okay, or let me do something and just show you something. There is the technicality of how to use these things. I'm not teaching that, I'm just showing you that these things really exist. If you learn how to use it, it's going to change your trading significantly, trust me when I say that. So this is a fair value gap also in a bearish trend. You can see that the low of the first candle and the high of the third candle, they don't match. That's a fair value gap. Price straight into it, and look at how price never went into the other block and price started going down. Look at how price only retested this fair value gap and starts going up. Look at how price only tested the fair value gap here and starts going up. So you can see that other block really is not all that there is to smart money concept. There are a lot of things you are missing out from SMC or smart money concept, and the earlier you start incorporating these things, the faster you will come into your level of precision and profitability in trading. Okay, in trading. Sorry. So this is another one there. Look at how price traded into it and starts going down Now some of you might ask, okay, how about trading just other blocks? Well, you can trade other blocks, but it simply means you are going to be missing a lot of entries also. But if you learn how to apply these things as they are, I assure you, you are really going to see the beauty of this thing. So that's what a bullish, that's what a fair value gap is. Now let's identify other blocks. We said there are two types of other blocks. Okay, there are two types of other blocks, and I mentioned that there are nitty-gritties to how to use them, but I'm just teaching about their existence. So we said a bearish order block is the last buy candle that was traded to the opposite direction. Okay, you can see in all of this price action, this is the largest buy candle that was traded through by an engulfing candle. Sometimes it can be more than one candle that breaks this low. It is also considered as a bearish order block. For example, in this case, you can see that there's a buy candle here that were traded through by 1, 2, 3, and almost 4 candles before the body of the candle closed below that low. That is also a bearish order block. You see that? That's a bearish order block. Okay, then here you have also another bearish order block, the last buy candle. The buy candle in this case is the blue candles. Oh, it's the blue candles. I chose the blue as my own buy candles. So you can see that this is a bullish order block, not this small candle that was traded to the opposite direction in this case. Okay, so let's check, is there another bearish order block here? Of course there is. There's another buy candle that was traded to the opposite direction. This is also another bearish order block. Then all of these 3 candles that were traded to the opposite direction, it is also a bearish order block. Okay, that's how to use order blocks. Then let's quickly identify a bullish order block. A bullish order block simply means last sell candle that was traded through to the opposite direction. You can see in this case 2 candles engulfed this last 1 candle. So this is a bullish order block. Price retested it multiple times and then took off from that region. Okay, and then we see that's happening again and again and again and again and again. In the charts, is there a bullish order block here? Yes, there is. This last sell candle that was engulfed by the this last sell candle that was engulfed by 3 candles, okay, is a bullish order block. Now, when an order block candle is large, you take note of 50% of that range or the candle. It is called order block mean threshold. So I'll measure the high to the low of this candle. 50% is order block mean threshold. And why am I doing that? Because I see that this candle is a large candle. You use the Fibonacci to measure between the high to the low, and then 50% is equilibrium of that candle, right? You will pay attention to it. Sometimes you can measure just the candle body, okay? Instead, you can measure the candle body sometimes, or you can choose to use the candle wicks. But anyhow you do it, pay attention to the candle. Pay attention to 50% of the candle range. It is called order block mean threshold. So that's a bullish order block. I want you to go through the chart and I learn to identify these things again and again and again and again and again. Okay, that's what it is. Okay guys, now in a bullish order flow or in a bullish trend, bullish order blocks are going to be supporting price. In a bearish order flow or in a bearish trend, bearish order blocks are going to be supporting price. Okay, just like in this bullish trend, you can see that this is a bullish order block. It's supporting price. Bullish order block here, supported price. Okay, we have another bullish order block here. We have another one here. The last sell candle was traded through. You can see that retested twice. You can see that. You can see that happening. Okay, in this case it's not. Then you can see another order block here. You can see another order block supporting price here, bullish order block. Okay, I believe with these few examples you can really identify these things yourself and on the chart. Then the next is a rejection block. Remember I said a rejection block usually is a 3 candle price action where the body of the candles usually are equal, but the middle candle has the longest wick. Okay, sometimes institutions will go there to pick up liquidity. You will go there to pick up liquidity most times. Now look at this. This is 1, 2, 3 candle. Okay, and then look at the body of the candles. The body of the candles here are equal, but I do not see the middle candle having the longest wick, so I would not say that that is a rejection block. Okay, so let's quickly check through whether we see any recent rejection block that price action happened around it. I think I've seen one here. You see this 3 candle price action, the middle candle having the largest wick, and look at the body of the candles here is actually equal. That is a rejection block. So you just mark here, that is a rejection block. You see that here, right? Rejection blocks are usually rare to see, but sometimes the institutions can do a deep repricing into those levels to pick up liquidity and then start trading in the opposite direction. Let me run through and see if I can still find one more example for you, and then we are done. We're done with this. think I have seen another one. Look at these 3 candles here, the middle candle having the longest wick. Look at the body of the candles, relatively equal. So this is a rejection block too. Price retested that region again and again, and then took off. You see that? Price went into it immediately, traded off, still went into that rejection block, traded off. So that is a rejection block. Then the last one is an old high or old low. Look at an old low, look at an old high or old high, look at an old low, look at an old low, an old high I meant to say. Look at an old high, look at an old low, old high, old low. That's what that means also. Okay, so usually price trades into an old low or high to take out liquidity. You know that above an old high resides buy side liquidity, and below an old low we have sell side liquidity residing below that. So in a reversal pattern, or when there is about to be a reversal pattern, institutions usually will trade into an old high to take out liquidity before the reversal, or they will trade into an old low to take out liquidity before the reversal. And then sometimes the institutions pair up their orders at an old low or an old high. Let me look for a typical example to show you where that really where that has happened in the past. Okay, the institutions can pair up positions at an old low. So like in this case where we have a breaker block, but this is an old low, right? Let's see if that has been paired up. Okay, in this case it has not been paired up, so let me quickly run through and still look out for another one. That's not what I want to see. I know what I'm looking for. Good, this is what I'm looking for. You see this old low here? Look at how in all of this price action during this retracement we do not see a break, we do not see a mitigation block, we do not see a breaker, we do not see, there is a liquidity void, yes, there is a fair value, and then we are seeing an old low here. Look at what the institutions did. They went straight up into this sell side imbalance and the buy side inefficiency, and then paired up their shorts with the old low in this range. I'm going to do a video to teach you how to apply these things, okay, next time. So guys, I hope you really enjoy my video. If you are not subscribed to this channel, don't forget to click the like button, share, subscribe to this channel, and until next time, I wish you good luck, good trading.